Welcome back, everybody. So today we're going to be talking about determining exchange rates in the short run. Now, before we go any further with that, keep in mind that this is a theoretical discussion and that there is no perfect way to determine exchange rate movements in the short run. What we are discussing here is the beginnings of thinking about a theoretical structure for what would explain those movements, or at least a way in which we could analyze those movements. All right. Now, with that in mind, over here in the PowerPoint, you see what's referred to as interest rate parity condition. It's one version of an interest rate parity condition. In this case, the uncovered interest rate parity condition. You'll find a covered version of the interest rate parity condition in the reviewer material for this lecture available in the course. You can also find many versions of both of these with a quick internet search, as it is an extremely commonly used mathematical relationship. All right. Now, what this relationship shows you, as per the learning goals that were on the previous slide, is the relationship between interest rates and exchange rates and global capital movements. Now, what we see here is the idea that a domestic rate of interest, in this case expressed as dollars, so the interest rate on a dollar-denominated asset, should be equal to the interest rates denominated on a foreign asset plus expected movements in exchange rate. Okay, so to see how this works, let's grab a little Excel file I made a few moments ago here. So you should be seeing over here now some values that I've just chonked into this. Let's say that, I got the answer there. Let's say that, that the interest rate in the United States is 6%, which I've just plugged in 6% into this Excel cell here. Then the euro interest rate is 3%. Let's assume, for simplicity's sake, that the exchange rate is currently 1-to-1. That is to say, $1 buys €1. Okay. Well, if all that is true, in other words, these three things are true, then we would expect this to be the movement in the exchange rate. That 103 would be the expected depreciation of the dollar associated with taking up the slack between those. Let's get rid of this just a second. Taking up the slack between those two different rates of interest. So, well, let's go back to the PowerPoint. So let's say that rate of interest in the United States is 6%, right? And the rate of interest in the Eurozone is 3%. In this case, we would normally expect, right? We would normally expect capital to leave, in this case, the Eurozone and enter the United States. However, if the market generally expects the dollar to depreciate, in this case, let us say that the market expects the dollar to depreciate 3%, roughly speaking, over the next year. Then, in fact, this condition holds, and we don't expect any capital movements. Okay, let's take a look here at this result. Okay, so looking up here in the box, right, we're taking our value for C5, our value for C7, so C5 is here, right? C7, C6, right? And we're using Excel to generate the result for this. So this is here. The right hand is expected change in the exchange rate, and this is the foreign return on the asset. And so the total of this gives us the domestic return on this foreign asset. So let's say that we expected the foreign asset to earn 4%. Okay. Well, then the solution to that right-hand side of the equation would be 7%. And we would find that indeed then the foreign return would be greater than the domestic return. And so then capital would start moving, right? If it's 3%, then the two returns are equal to each other and capital doesn't end up moving. If it's less than 3%, 2%, then we find that the domestic return ends up being greater than the foreign return. And we would expect capital to flow into the United States at this point. So the point at which this condition is set equal, okay, let's get rid of this now and go back to this. The point at which this condition is equalized is the respective rates of interest in which capital won't move. So if it turns out that this over here ends up being greater than this, then capital will flow to the Eurozone. If this ends up being greater than all this, then capital flows to the United States. So what we have here in this little relationship is a way of explaining why capital moves from one place to another place to try to receive greater exchange rate adjusted returns. Okay, this is probably the simplest variant of this equation. Okay, so reading here, right? So one thing too is if you're having a hard time following this, please go back and review the PowerPoint on the rudiments of national income accounting and particularly current financial and capital account aspects of national income accounting. Okay, so this uncovered interest rate parity condition gives us a way of thinking about how the capital moves and why capital moves. Okay, there's also another very interesting thing that this equation illustrates, right? And that's the idea of the relationship between exchange rate policy, that is either utilizing fixed or floating exchange rates, and domestic monetary policy. What the uncovered or any interest rate parity condition shows you is that you effectively can't do exchange rate policy and monetary policy at the same time. You have to choose one or the other, with a notable exception that I'll address in just a short while. So, for example, countries like Saudi Arabia that utilize a fixed exchange rate, their currency, the Saudi Riyal, is pegged to the US dollar at a specific ratio. They are not able to utilize internal monetary policy. So the stuff that we do here in the United States, choosing targeted interest rates to maintain price stability and employment stability, that's not an option for the Central Bank of Saudi Arabia. Okay. Similarly, nations that employ domestic monetary policy must effectively float their exchange rate. That is, to not fix their exchange rate. All right, to understand why this is, let's take another look at this equation. Let us say that we wish to control I $. That is to say, we wish to operate or utilize conventional monetary policy in the way that we do in the United States, or the way they do in Canada, or in the Eurozone, or in Great Britain, or Japan, or several other nations. Okay, so we want to control this. We can't control this. The United States as a nation cannot control what the European Central Bank does. It cannot control what the Bank of Japan does. Can't control what the Bank of Canada does. Okay, so we want to control this, can't control this. If we want this to remain fixed and this is going to move, then this has to move inversely with this. So if we wish to hold interest rates constant domestically, and let's say interest rates go up overseas, then we need to allow movements in the exchange rate to take up that differential. Okay. In this case, we would find that if this moved up, all things being equal, okay, we would find that capital would start moving overseas, causing what? Causing a depreciation of the dollar, as well as an appreciation of the euro. Until when? Until this equation held again. Okay. So let's continue on. This idea that you can have sort of monetary policy or exchange rate policy, as well as a third policy option, is known as Triffin's dilemma, or the Triffin trilemma, or as the way your textbook simply calls it, the foreign policy trilemma. Okay? And that goes something like this. Okay? We've already got two parts of it. Ah, boy. I hate it when that happens. What that tells us is that we can have monetary policy and free capital flows, or we can have exchange rate policy and free capital flows, or finally we can have fixed exchange rates and of internal monetary policy but no global capital flows. Okay, take a look. So we could fix this, let this float. We could fix this and let this float. Or we could just decide that capital can't move between these two countries, and so this whole equality becomes irrelevant. So there's nations that have chosen one. All nations have to pick one of these three choices, right? Different nations make different choices for reasons that we'll be talking about for the remainder of this term. In the United States, we allow capital to move into the country and out of the country. We also fix domestic interest rates. Okay? So that's R2. We let exchange rates float. Saudi Arabia, as I mentioned a moment ago, as well as most other resource-rich nations like the UAE or Qatar or Venezuela and so on and so forth, they tend to fix their currencies. So they also allow capital to move in and out. You can invest in Saudi Arabia, and if you're invested in Saudi Arabia, you can divest from Saudi Arabia. They fix their exchange rates. What can't they fix? They can't fix their local interest rates. It's rare, but some nations, such as North Korea, pursue the third option. They control internal rates of interest, they control the exchange rate, but they don't allow capital to move in or out of the country. You can't invest in North Korea, and if somehow you manage to invest in North Korea, you can't divest from North Korea. So as a consequence, their internal markets for capital, are unaffected by global competition because there simply is no market. Okay, so each nation chooses two, right? They have different policy ramifications, they have different economic ramifications for how those economies will operate and what sort of concerns and problems they will have. And the reason why those nations have made a choice is they've weighed the cost and benefits and come down at the best option for them, right? And said we'll talk a lot about, why Saudi Arabia chooses to fix the rial, why we float the US dollar. The short answer right now is to be able to monitor, be able to control internal interest rates is in some ways the highest objective. It is a luxury that developed nations are allowed to do. It's not any authority except the market that allows them to do that, right? If you're a small nation, then it's far more difficult for you to control anything. Okay. So we'll be coming back to that quite a bit in the coming lectures. Let us now shift over to interest rates locally and money markets for a little bit of a short reviewer here. There's a more extensive reviewer available to the class. So short-term rate of interest in any given country is largely, although not exclusively, determined by the money market, the market for liquidity, okay, cash. Let's start from the idea that this is fixed by the central bank, right? Whether it be the United States or Canada or Mexico or Japan or whomever is going to control the supply of liquidity to an economy. And then that leaves with the demand, right? So why do we demand liquidity? Well, we're going to build a simple little model here. And this is roughly based upon Keynes's work in the 1930s. Okay, Keynesian economists don't get too worked up. But yeah, I know it's not. It's really a. It's kind of a junior version. All right. So the first we're going to say is that people demand cash to buy things, right? So it's like you want to go to the store and buy things, so you're going to get some cash. You go to the cash machine first, all right? We're going to call that transactions demand, all right? Second, we're going to say that people hold money as a speculative asset. Now, some of you might be saying, well, why would they do that? It doesn't earn any interest. Just bear with me for a little while here, okay? We're going to call that demand for money speculative demand. Okay, so we've got transactions demand, speculative demand. And we're going to give that little model some specific form. We're going to say that the demand for money, MD over P, that is to say the price level, which gives us the real demand for money, right? So real meaning adjusted for inflation. Okay. We're going to say that that's a function of two variables, people's incomes, or the letter Y, which we always use in macroeconomics to denote incomes, and lowercase I, which we generally use to denote nominal interest rates. Okay, so let's now give a specific form and say that MD over P, or real money demand, is equal to some variable K times Y. Okay, what is K? K is how responsive money demand is to changes in Y. So like, let's say your income doubles. You know, how much more do you take out of the cash machine each time you go visit? That's K, okay? Transactions demand for money. All right, minus LI. Okay, well, how much does the interest rate, remember that speculative demand for money, you might have been a little concerned about that a moment ago. But how does the rate of interest impact your demand for money? Okay, if the interest rates are very low, like right now, you probably never even thought about that, right? You go to the cash machine, you get out, $50 or whatever for the weekend. You don't sweat about the interest you're going to lose in your savings account. But what if interest rates were a lot higher? What if your savings account was earning 20% per month? Well, now you'd really think long and hard about holding on to any cash in your wallet that you didn't need right now. You see, there's an opportunity cost to holding cash. That opportunity cost is the interest that you give up. So this is what gives us a speculative demand for money that seemed a little questionable just a short while ago. Now it seems like, oh yes, of course. Okay. We've put a negative sign in front of this because, of course, at higher interest rates, you would expect people to hold less cash. And at very low interest rates, they might hold all their assets as cash and not really be concerned about it at all. What is the rate at which changes in the interest rate impact money demand? We've used the letter L to denote this here because L is short for liquidity preference, which is a term economists use quite a bit. What is people's preference for liquidity? How much cash do they like to hold? Okay. There was actually a paper I saw that came out towards the beginning of all this COVID mess, right? And it was speculating that liquidity demand was actually falling because people would think that paper money, would maybe give them COVID, and so they wouldn't hold any of it. Maybe you're right? But it kind of illustrates like, okay, what would change like liquidity preferences? Like, I mean, it's pretty well established that like cash machines change liquidity preferences. I mean, imagine if there was no ATM machines, and which there weren't before the early 1980s. So you want to, and of course, at that time there's not really many credit cards either, right? So if you want to go out on the weekend and spend some money, right, you need to get to the bank on Friday before they close and get some cash out. And if you're going to spend all weekend, you're probably going to get a sizable amount out, right? So we don't think too much about cash holdings as individuals today, but in terms of the economy, it becomes quite significant. But when we think just even to the fairly recent past, one recognizes like, oh yeah, this is an important issue. Okay, so this is our money demand thing here. Okay, gives us this idea here, right? This is what we were just talking about. Right. Okay, So this is also what I was just talking about, liquidity preferences and so on. Okay. Here, we're just taking this over P, right, to get, this is, of course, nominal money demand, or if, as it mentions here, we're holding prices constant, which would make sense to do in the very short run because we don't worry about the inflation rate between today and tomorrow, or even today and next week, or even today and next month, generally in stable economies. So if we can sort of dismiss that from our model to make everything a little simpler, we end up with this idea here that the money supply will be equal to the simple money demand equation, right? So here's real money supply, here's our real money demand, right? Getting rid of the P's from both sides, right? We get this idea here. This is equilibrium in the money market. And of course we can see that if there's, expansionary monetary policy, right, then this is going to increase. And if Y remains constant, then we can see that I would have to fall, right, which is what we would expect, all things being equal. Similarly, contractionary monetary policy, if Y remains constant, then I has to increase, okay? Okay, so here we're putting all these ideas together, right? So our stuff that we said at the beginning about exchange rates and their relation to interest rates, and now also thinking about interest rate determination in money markets. And the method that we've just laid out is laid out here in this upper box here. The previous chapter from your text, which we'll be talking about in the, so I did it in reverse order, right? That's for reasons that I'll probably talk about later. But in the next video, we'll talk about this lower approach, which is the long run approach in much greater detail. But here we see the relationship of all these things. Now, so we could say, let's put it all together, right? So let's say there's expansionary monetary policy. Interest rates go down, right? Well, then going back to the equation, the interest rate parity condition above, if the interest rate goes down, then we expect capital flight, right? And if we have capital flight, then what? Then there's supply of dollars, there's demand for foreign currency, so the dollar depreciates in relative terms against foreign currency. Okay, so in terms of monetary policy, right, in the short run should reduce interest rates, expansionary monetary policy, and that reduction in interest rates should have a negative impact on exchange rates, all things being equal. Okay, and the reverse would also be true. Would also be true, right? So contractionary monetary policy should raise interest rates, which should attract global capital, which should cause the currency to appreciate. All right. Okay, so right. So here I mentioned it, right? Okay. Okay, so here's what I was talking about a moment ago. I encourage you to practice these things, right? So like if you're sitting there with a friend or something, you're probably not sitting with a friend watching this right now. Maybe you are. Maybe it's social hour. Let's watch Kemp do these goofy videos. If you're sitting there with a friend, run through these a few times. Say like, okay, well, what if the Fed does this or what if the Fed does that? How would I expect that to impact exchange rates? Or you could also say like, well, when the Japanese central bank does X, right? How would I expect that to affect the price of the U.S. dollar vis-a-vis the Japanese yen? Or the Canadian central bank, or any other foreign central bank. Okay, so here in the last slide, I come back to this idea of the idea of capital controls, right? So I'm just going to let that slide be there, right? And we're going to come back to that in a future video, right? So the question here is, right, is there any way for us to avoid foreign agents, foreign central banks from impacting either our exchange rates or our interest rates? And the answer is yes, right? And that answer is through capital controls. Now in the United States, this isn't really something that we discuss very much, or that frankly is very important for the United States. But for smaller nations, it's not uncommon for them to find themselves in a position where they want to isolate themselves from global capital markets. And then so they utilize these alternative measures that we'll be talking about more then. All right, I think you've got the idea now. So again, learning goals, interest rate determination, exchange rates, relationship of exchange rates and interest rates, interest rate parity condition, what it is, be familiar with it, okay, and how it works. All right, thanks everybody. If you have any questions, write me. Okay, take care. Bye for now.